I tell everyone, bootstrap, don't fundraise. A lot of founders be like, oh, it's this, validation point. I want to raise money. And don't do it. Don't do it if you don't absolutely need it.
What you're about to hear is my conversation with Jason Kirby, who is a serial entrepreneur turned VC. Jason has built multiple companies and sold multiple companies before. Today, he's on a mission to help a lot of founders raise better capital. He's raised $40 million for his own ventures, and he has helped founders raise more than $100 million. When should someone raise money and why they should raise money?
A lot of founders also aren't building what they think they're building something venture backable, but they're not. Guy has what could be a very good, healthy, 10, 20 million, $30 million a year business that could be very profitable. And I was like, you should be selling customers. You shouldn't be selling VCs. I think a lot of founders just get hung up on the ego validation of what venture capital comes with. They think that if they can convince investors to give them money, that their life will be easier. Businesses shouldn't be looking for venture capital to validate their business, but there's just this sex appeal that founders have to be venture backed. Wait to raise capital until you actually hit a very defendable inflection point, not when you're desperate. If you go out and try to raise money when you're desperate.
Hey Jason, welcome to the show. How are you doing, sir?
Hey, doing great. Thanks for having me on the show. I'm excited.
So every single time I have any guest on the podcast, I start with one particular question. So I'm going to ask you the same question as well. And that is, what's your story? Who is Jason Kirby behind whatever you're doing today, wherever you are today? What's your story?
My story starts pretty early in my career. I decided I wanted to be a founder and start a small business. So started my first business when I was 19 and realized that working for anyone else was going to be very, very difficult if I wasn't building a company or kind of running the show. So that's kind of been my path ever since. And started my first business, like a photography business, because I like photography. I'll start a photography business, follow your passion, that kind of stuff. Didn't realize that would turn into a multi-six-figure business and allow me to travel the world, and I ended up selling it and turning into the largest photography school in San Diego. Ended up being a learning ground for me to kind of experiment from marketing, hiring, sales. Learned a ton while running just a lifestyle service business, but realized that I always wanted to do more. I didn't want to be labeled a photographer. I saw myself more as an entrepreneur. And so decided to kind of go into the venture-backed world, try to go raise some money, failed miserably. Raising venture capital in San Diego in 2013 was unheard of, especially pre-seed, what would be considered pre-seed today. Pre-seed didn't exist back then. We were growing at 40% month over month at 40K a month in revenue, and no one gave a shit. Yeah, that was crazy. You do 40K a month now, you're all right, easy. You're gonna get $3-4 million on a $15 million valuation, and we were raising $1 million on 3, and no one cared. So that was a really harsh learning experience going through that. I ended up getting an acquisition offer from Kodak, which was pretty cool, but fell through the final hour. We had to shut down the business. It was pretty swift kick to the gut. As a founder, you kind of worked on it for a couple of years, didn't work out. I was wrapped up with my identity for quite some time, but was fortunate to relocate out of San Diego and go to New York, and worked on scaling a company called Liquid Sky. So I came on as kind of the first strategic hire. It was just me and the two co-founders working out of the co-founder's parents' house and building this company, and ended up being pretty successful. We raised about 12 million building an ICDN, an interactive content delivery network. First product was a cloud gaming product, and raised about 12 million, sold that to Walmart. All kinds of wild stories in that journey, but I'll keep it brief for this. And then learned a ton over those years, got into HR tech, helped them raise about 20 million for an HR tech company that ended up selling to a competitor. And then went into the ed tech and esports space, raised $11 million Series A for that company. That one's still operating today, and decided to be where I am now, partnering with a VC fund, Interplay Ventures here in New York, to launch Thunder.VC, which we consider a tech-enabled investment bank. But that's kind of my entrepreneurial journey. But other than that, I'm happily married for 10 years, have a 2-year-old daughter, and love to snowboard whenever I get the chance, and cycle. So that's a little bit about me.
Awesome. Tell me one thing. Why haven't you considered bootstrapping out? Like, because all the companies that you mentioned, it was like raising money, 12 million, 20 million, 12 million, something like that. Like, how much did you raise in total? Close to 100 million?
Personally, I've raised a little over 40 for my ventures, either helped other companies or assisted other companies or invested in other companies that went on to raise 100 million total, or about 110 and change or something like that. So I've just been deep in this world of fundraising, and I tell everyone, bootstrap, don't fundraise. If your business doesn't need to raise capital, don't raise capital. A lot of founders be like, oh, it's this, validation point. I want to raise money, and don't do it. Don't do it if you don't absolutely need it. And yeah, I would say the businesses I had built needed it, with especially Liquid Sky, we had to have massive GPU cloud infrastructure. You just can't. And we're charging $20 a month to end users. It's a scale thing. So that was absolutely necessary. And so was pretty much every other company. It was a heavy tech investment up front that had, only economies of scale would it be profitable were the last few companies. And now I'm doing something different. Now with Thunder, I'm, raised a little bit of money to kind of get some tech off the ground, but kept it real close, friends and family, angels that I know, very small amount of money, and focus on profitability.
One question that I want to ask you, later on, but now that you've mentioned, so when I ask you right away, is you said every single founder that you meet today, you would tell them to just go and bootstrap, right? My question to you is, when should someone raise money, and why they should raise money?
So it really depends on people's preferences. Okay. So if you're going out for the moonshot and you're building a business that has $1 billion potential, and you have this vision that you have to see come through, and you have this conviction that you are the person to do it, and your team's the people to do it, and it needs, again, economies of scale to get there, looking at venture capital is appropriate. When I usually encourage people to kind of raise very small, friends and family, convince the people close to you to believe in you and back you to get that initial couple $100K in the door. And or if you don't have that network, apply to accelerators to get that initial capital. But in this day and age, pretty much recent, previous couple of years, it was a lot easier to raise a lot of money very quickly with not a lot of validation. That's obviously shifted. Everyone's kind of regretting those decisions, and now you need a legitimate business. You need to have unit economics. You need to have a path to profitability. You need to have a plan in place to grow a real business. And a lot of founders also aren't building what they think they're building, something venture backable, but they're not. And or they haven't told the story for someone to believe it. And that's something that holds back a lot of founders from just focusing on building a profitable business. Focus on offering some services, even though services makes you unattractive for venture capital. But if you get to build your business, sustain yourself, pay your employees, you're growing and you're slowly working on the tech, and you grow slowly over time, you'll retain more ownership, you'll have more control. And then when you finally hit some kind of inflection point, then money's easy to get. But when you're in that early days, you don't have any validation, any traction or anything like that, and you don't have a track record, it's a tough place to be raising capital. And I don't really advise people to chase that path unless they really, really believe it and have validated at some point in terms of either convincing potential customers or convincing investors.
You mentioned something that agency business, which is obviously not as sexy as a SaaS startup or something like that. So and totally makes sense that later on you can raise money. My question was, as a founder, how do you know whatever you're building is venture backable or not? So I'll give you some anecdote to just, clear the question up. I think in this particular year, at the start of this year, ChatGPT came along, the LLMs and every single thing was public and people can use to build something. And every other dude that I met on LinkedIn was building somewhat of a wrapper and then using the same LLMs, producing it. And then they changed, I think last month or something like that. And then what happened is a lot of these startups just die, just like that, right? And I hosted a lot of VCs on the podcast. And one of the questions that I ask is, what do you think is an AI backable investment startup? Do you see anybody out there? And they were there's going to be few, but not right now, because everybody who's just building a wrapper is not going to be an investable business, right? So the question that I want to ask you is, people get all kinds of ideas, and everybody believe, at least at the beginning, that their idea is worth $1 million, $1 billion at least, right? So that's the nature of the business that we're in. But from a VC standpoint, how do you evaluate, like, this is a business we should be investing in, and that's a business like we should be staying away from? How do you do that?
Yeah, I saw a recent post the other day called tar pit ideas, or like the idea of tar pit, and stemming on the premise that, like, tar pits lure animals in, looks like water. Yeah, I was like, oh, there's no one around. I get all this water to myself. And they go in there and then they're like dead and like sunk in and they can't get out. They're screaming for help, but no one gives them any help. And I feel like there's a lot of those ideas. And it falls mostly, I would say, on first-time founders that just haven't had the experience or the exposure to know what those tar pit ideas are, which, like a better way to do social shopping online, or, another social media app, or, another kind of like simple travel app, or, there's, you name it, there's a million of these, kind of tar pit ideas that a lot of founders have tried to do, but nothing ever came of them. It's hard. It's really hard. I spend actually a lot of time with founders that come in, they give me their pitch, and I'm one of very few investors and people in this space that actually tell what I really think.
So you don't do you guys are too early, you're too late, that kind of stuff. You don't do that? Okay.
No, because I think it's a disservice, because I wanted, that's what everyone told me when my very first company, and it wasn't successful. Everyone said that to me.
Okay.
And I chased and chased and chased and chased a dream that wasn't going to happen. Rather than, if they would have said, what you're building isn't venture backable, but it could be a good small business, maybe you build it that way. If someone would have told me that when I was building that first business, we actually could have made that a profitable business if we thought to build the business that way. And it was not venture scalable. It wasn't. And I didn't know that because I had no experience. So I feel it's a total disservice when investors just kind of like don't want to, granted, I know why investors don't do it. It's a burden to take on that responsibility and potentially shape a person's life, and you're just one opinion. But I feel like that opinion is going to be thrown at them sometimes. And I see a lot of founders like come to me and they're checking all the boxes. Great founder, great everything, energy, all that stuff. I just look at them and I'm like, your idea won't make it.
My God, it's
then, it's like, and but then I say why, and I give them all the advice and feedback, and and then they start telling the truth, and they start saying, well, yeah, we only have enough cash for one more payroll. We only have, they start telling these like, oh yeah, like they were really trying to oversell this thing, but like investors can sense the desperation, and they know that they don't want to throw money after something that's not going to last.
Yep.
Or be like the last check in the company that before it goes bankrupt. Like no one wants to be that investor. So I just try to do that as a service to the founder community and just be honest with them and tell them the truth. And also, some people are building great businesses, but they're wasting their time chasing VCs.
Something that you were doing.
Yeah, just like don't chase. I just had a call yesterday. Guy has what could be a very good, healthy, 10, 20 million, $30 million a year business that could be very profitable. And I was like, you should be selling customers. You shouldn't be selling VCs. Like, you don't need a ton of startup capital. You need a couple $100,000 to get, the first couple contracts going. Like, VCs are never going to write you a check for this sector in this industry. Like, it's just never going to happen. And he's like, but I'm getting all these meetings. I was like, because you got an interesting background. They just want to talk to you because you got an interesting background. They don't actually think they're going to invest. They just want to pick your brain and have a conversation, add you to their network. VCs take meetings for a wide range of reasons, and most of them have nothing to do with investing.
What are those reasons?
Yeah, VC's job is to like stay equipped with most recent knowledge, newest ideas, newest people, and expand their network as much as possible. And founders are coming in thinking they're getting the meeting because they're going to get a check, and it's very, very rare that happens. So again, managing expectations is something that I really try to help founders figure out and kind of navigate for themselves.
Okay, yeah, that's super helpful. So again, just a dumb question to ask on top of that is so it was reading the stat, I think Crunchbase put it out, or like somebody put it out, and that stat was like 1 out of 100 people can ever get venture capital. That's a percentage, right? So why do you think there's so many rejections?
Well, one, there's venture capital is like 1% of the kind of capital markets.
Okay.
And when you think about it, venture capital, which is like the most nascent, private market capital, it's like what, 200 billion or something like that a year. But like private equity is like a couple trillion,
Yep.
Like real estate's like trillions. And like, it's just such a small scale of what venture actually is. And it's like a 1% bet to most investors. So it's just not that, much capital out there in general. And then when you look at the businesses, it's again, businesses shouldn't be looking for venture capital to validate their business, which is what a lot of founders do. it's a lot better to go out and build a real business that makes money and makes profit, which is the majority of the market out there. But there's just this sex appeal that founders have to be venture backed. And the real story is, like, if you're not well connected, you don't have a track record, getting funded is 20 times harder.
Okay.
Period. Like, for me to go out and raise money now for myself, I can get money pretty quickly because people know me, I have a track record, and I'm just like, hey, I just want a couple $100,000 for this. I get it within a week or two. And it's like, great, thanks. Couldn't do that for the life of me 10 years ago. That was absolutely impossible. And so I just, like, founders just have to realize that there's an uphill battle and it could suck a lot of your time. And if you haven't really found the momentum yet, and like, that's the other thing, is like, wait to raise capital until you actually hit a very defendable inflection point, not when you're desperate. If you go out and try to raise money when you're desperate, it's not going to work. And this education, as much as it's out there, and there's so much amazing free education out there for founders and stuff like that, it's just, until someone you trust tells you this feedback, founders have a hard time accepting that reality, because there's so much hustle porn, as they say out there, like, you got to go, like, don't quit, keep going 100% all the time, and I think that's valid in almost all circumstances. You got to really, put the effort in, otherwise there's no chance of success. But, look at the writing on the wall. Like, are you not able to get any meetings at all with investors? Are customers kind of not that interested in your product? Are they kind of churning out? Like, you haven't figured something out yet, and either you need to rethink how you're doing it and do a pivot, or, throw in the towel or work on something else. And I think a lot of founders don't listen to those signals early enough.
Okay. How do you think Thunder is helping founders?
Yeah, love talking about that topic. So Thunder, in and of itself, is a tech-enabled investment bank. We help companies define their capital strategy. So whether that's debt, equity, or M&A. And we provide a wide range of free tools to help founders kind of navigate which VCs they should be targeting. Because one of the other problems is people are told, get warm intros. Warm intros. But they don't realize there should also be some targeted research on who you get warm intros to, not just warm intros to anyone with money, but warm intros to people that are deploying money into what you're doing. And so Thunder provides kind of an AI targeted list of VCs. So rather than say, go spam 3,500 VCs, it's, hey, of 3,500 VCs, these are the 30 that are most likely to engage with you. And it's kind of a barometer too. We give some benchmarking tools that kind of show you where you are in the scope of things. So if you have a really low score, you probably need to work on some stuff before you, go out for venture. Or if you have really low match scores, there's probably something wrong with your business that is not venture backable. Maybe your business could be fine again, but not venture backable. And so that's why we built our AI and our algorithm to kind of help founders benchmark against themselves, and then identify which VCs they should spend their time on getting warm intros to. So that's one of our free tools. And we have a debt finder tool. So if you're looking for working capital, so if you have some revenue, you can get any kind of debt product from $10,000 up to tens of millions of dollars, whether it's venture debt, invoice factoring, all the different tools out there. And we help streamline that pretty efficiently to kind of get you access to who actually will lend money to you. Don't go to your local bank, because if you're a startup, your local bank doesn't care about you, but they'll make you do all the paperwork to tell you that they're not going to do anything with you. And that's the other thing I see founders, we're getting an SBA loan. Like, you're not going to get an SBA loan. But they're giving us a lot of positive feedback. No. They don't know what they're talking about. They don't know what startups are. You're burning money. SBA doesn't give money to people that light money on fire. And so, but it takes 3 months of your time, and it's like the most, it's a pretty sizable anal probe experience, when it comes to going to your national bank. So, we work with private lenders, private creditors that are investors that, charge a higher yield or interest rate, but you can actually get the, capital, and it's a much more efficient process. And there's so many niche lenders out there, it's hard to know who to really go to. And a lot of these people are off the map. Like, they don't have like extensive marketing campaigns. Like, there's a couple players in the space that are like startups that do like revenue-based financing, things of that sort. But it's hard to know which one would fund you.
And that's a big problem.
So that's what we help. And then we have our newsletter where we provide free content. We have our own podcast where we interview founders that have recently raised capital in the current market and share their insights of what's working, what's not working, with a wide range of stories. Some people like, I had an idea. I called some friends. I raised $20 million. And you're just like, oh, I hate you. And then you have these other founders are like, I've worked on this for 8 years and we finally, were able to raise money. But we did this, and this. So it's kind of fun to hear the wide range of stories that we get on the podcast.
Like, what's one common thing that you have observed or seen after interviewing all these people? What one common thing that you have seen? Like, okay, so like you have interviewed how many people so far?
We've had 30 recorded shows, 24 published.
What's the common denominator here? Like, okay, so all these people have successfully raised money. And if you were to suggest anybody who's listening to our show and who's looking to raise money, what would you tell him?
It's a completely bespoke experience for every single.
No one size fits all.
There are strategies that are out there that work. You have to choose the right strategy for who you are and what you're building and where you're at. And as much as I wish there was just this magic solution, like it really comes down to who you are, what you've accomplished to this point, and then what are you trying to accomplish, and then and then assessing your network and seeing what's going to be the best path forward. And I would say one common denominator, and it's not true for everyone because again, it's completely random. Sometimes you can go to the right event at the right time, meet the right person, and magic happens. But a lot of it, like the ones that are most reliable, is you're hitting inflection points. You said you're going to do something, and then you did it, and then you did it again, again, and again. If you can do that with your business, whether you have a network or not, people will listen, and VCs will be wanting to learn more. It's the hardest thing to do without money, and that's one of the big problems founders say is like, how can I do that if I don't have money? Chicken and egg. But that's what makes the venture backable founders, those founders, is the ones that can pull off the really hard stuff.
2 questions that I want to ask you. So one is why people don't go and pick up that non-venture capital route. Like you mentioned debt financing, you mentioned private equity. Yeah, okay, I agree with you that it's not sexy, it's not very, something that you would want to mention on LinkedIn and people would praise you for that. So that's okay. But why people don't go and, have that route? What's the problem with that? Choose not to go for, I don't know, debt financing or, have a private equity firm or something. Like, why only focus on venture capital? Because you mentioned it's such a small market. So obviously competition is very, very high. Demand is so high, supply is very little. So like, why not explore all these other routes?
I think a lot of founders just get hung up on the ego validation of what venture capital comes with. They think that if they can convince investors to give them money, that their life will be easier. They're going to get bragging rights. They'll get on Forbes 30 under 30, and be the next the next SBN. I think there's a lot of vanity to it, but there's also a lot of the people that do it right. There's legitimate reasons. Like they are building something venture scale, and from an investor standpoint, it's worth gambling because that's what venture capital really is. Like the typical fund structure is 30 bets. They're going to have $100 million, and they're going to put 50 to work on 30 bets. Of those 30 companies, probably 5 to 8 of them actually hit some level of scale and start ramping up. They put the remaining 50 million into those 5 to 7 companies, and that's what they're betting their fund on. Only really one of them will pay back investors in full, maybe some. And so you just see 29 out of 30 are basically not worthless, but insignificant. Probably about 20 are completely insignificant. 10 maybe have some return, like a 1x to 5x type return, and they take a little bit of that money and pay back investors and generate what's known as DPI. That's the money, the cash that actually goes back to investors, which a lot of VCs forget about, and everyone forgets about for some reason. But that's, I think, something important for founders to realize is just they make 30 bets over 3 years, and they get about 1,000 pitches a year. As it's the volume game of this is just so much noise, and that's why they also require warm intros for VCs, because they just need some kind of vetting or filter to handle that capacity. As much as everyone wants to kind of find the needle in the haystack, And that's, what our algorithm does and stuff like that. It kind of helps give signal in the massive cold, kind of world of non-warm introductions. Like our AI can at least give signal on what maybe we're taking a second look at. But when it really comes down to it, VCs prefer warm intros just because of that sheer, the amount of volume they're dealing with, and they need that filter. So I tell founders, like, that's, it's a hard game to play. So you have to be 100% sure your business is venture backable and you can do what you have to do and, accomplish what you say you're going to accomplish once you get the money. Because otherwise, you're going after a very, very difficult path. And that's why I often push founders towards, like, how much capital do you really need to get to profitability and grow this a little bit more slowly? And it's like, oh, we only need $1 million. I'm like, oh, well, you're doing 4 million in revenue. Like, you only need $1 million. Let's maybe look at some debt options and model out what that might look like. And you could probably get that in a couple weeks.
Which is much easier. Yeah.
Opposed to going on a road show. Yeah. And you meet with like 2 lenders and, they do deals just like you and they do them all day long and $1 million is easy. Or M&A planning. It's like, hey, you built something that's pretty interesting. There's potentially a market out there. If you follow these steps over the next like 12 to 18 months, you get your revenues or EBITDA or your whatever, cash flow to a certain point. Here's the potential buyers. And you can create a liquidity event for yourself and you can potentially get rich, as opposed to, raising more capital, having a pref stack. And that's another thing that a lot of founders don't realize when you raise VC. There's a pref stack, preferential treatment to the money that comes in that gets paid out before any of the founders or common shareholders do. And, they kind of forget about that. And they're like, oh, we're going to sell for $50 million. It's like, yeah, but you raised 70 or you raised like 30 or something that with like a 1.5 lick pref. Like, you're not going to see a dime of it. Or a lot of employees don't know about pref stacks. So they see all this amazing stuff about their company worth hundreds of millions, but they raised hundreds of millions. So that pref stack gets paid out first and employees usually get the scraps. So it's just something else that, should be considered when exploring your capital options.
Okay. That was the truth, somewhat of a harsh reality, sort of a truth. One company that went public, like recently, I think Loom went public. They sold to Atlassian.
They sold that last.
I think that acquisition is close to $1 billion, right? Yeah. And I had a VC on the podcast a couple of weeks ago, and he was mentioning that was a down round. That was like, they had much higher valuation a few months ago, or I don't know, a year ago or something like that, and they sold for that. Can you share like one of...
Well, it was still a win for just about everyone, okay. I believe. They had like a 50% down round, I think, in that final one. But that last money in, again, pref stack, they got all their money out before everyone else got paid down the funnel. So that's typically how those deals did. If you're in any kind of growth stage, growth capital investors never lose money. Like that's their whole shtick. They never lose money when you come in that late. So they have preferential treatment that usually makes sure that they get at least their money out first in most cases. And in the last couple of years, those deals, like, things were a little frothy, maybe people overlooked some of that stuff. So it's not always guaranteed that was the case, but typically there's always at least a 1x liquidation.
I'll share some story with you and then let me know what you think about that. I happened to interview somebody who was an angel investor in Instacart way back. Like he wrote a couple of $1,000 check, and then very fortunately, the company went for IPO. He made like a lot of X's, on that. Well, he was very happy and stuff like that. But one of the things that he shared with me was, and this is something that as a student of venture capital, I want to ask you. So what usually happens, so somebody, gave them a 20 million on seed round, I don't know, like whatever, just assuming the numbers. And then the following up was maybe 50 or 70. The following up was 200 and then 100 to 300. Like they kept raising the money. This is one of the questions that I had in mind is like, if the company went public for like 1.2 and they, get all that money, the last person, which was I think Sequoia or like, all the brand name capital that invested the last round, they usually don't get, I don't know, 5x's, 10x's on every deal, right? So what's their investment strategies? Because early stage VCs usually get, as you were mentioning, like, one out of 30 is going to be a home run for them. And a home run would be like, what, 50x, maybe 100x or something.
That'd be the goal. 50x would be like...
Yeah, would be the goal. So all these, brand name, late stage, growth stage VCs, they invest a lot of capital and, usually there's like a liquidation event after, right after that. How to make more money? Because they usually get like their 1x out. So what are they doing?
Typically, so we call that growth stage capitals. That's kind of like the Series C and on investors. So typically, the investment strategy for growth stage is they're in it for a shorter period of time. So usually like a 3 to 5 year max time horizon before a liquidity event. Because if you're a Series C company, you're usually tens of millions, if not maybe hundreds of millions in revenue. Your acquisition prospects are kind of at your prime. I would say Series C is kind of when the, people really start paying attention. Maybe maybe you're as early as Series B from like private equity, strategics, that kind of stuff. You're big enough to, have a 9-figure or a, $1 billion exit. And so growth stage investors' purpose is like, they come in, they're like, okay, we can potentially they want to underwrite this for a 2 to 3x exit, maybe a 3 to 5x exit, but in the next, 3 years. So, and they have downside protection in most cases where they have some kind of liquidation preference on their capital, depending on how the market is right now. It's like a lot of the pref deals going on right now internally. So the rounds you don't hear about that are not getting published in TechCrunch are all the internal rounds that are happening as what's known as a pay to play. That means either new investors and or existing investors that are setting the terms, they're coming in doing 2x, 3x, 4x liquidation preferences on their money coming into this round, pretty much wiping out any previous investment capital because they're going to get paid out first. And so this is happening, and no one talks about these things because it sounds bad. But this is what founders are doing instead of doing a down round. Because down round gives negative signal for hiring, gives negative signal on stuff, but no one has to know what the liquidation preferences are. So it kind of keeps everything in the wraps, and it's kind of a dirty little secret that people use that gets investors to get them the money they need fast, but then doesn't give negative signal to employees. They're like, hey, we just got another $20 million in the door. But it had like a 3x liquidation preference, meaning if they've raised, say, 50 million, and that last 20 was at a 3x, technically it's like a $90 million pref stack. So if they sold for $100 million, only 10 million is getting paid out to, the common stockholders. So that's something that, later stage investors use as a tool to kind of help give them downside protection. So if the company ends up selling for, only 60 million, they're the ones that get all the money. And no one else gets anything because they're on top of the pref stack. The only thing that supersedes the pref stack is debt. Senior secured debt in most cases. So, or really any debt exceeds the preferred shareholders. So that's something that, again, going back to your question on what's the incentive for growth investors, they're typically shorter time horizon, but with a lower expectation on multiple return. So again, that like 3 to 5x, because if they get a 3 to 5x return in like 3 years, that's like 100% plus IRR. Like that's a home run. That's like a grand slam. It's a great deal. And so they try to find deals and underwrite deals that can yield the shorter turnaround to liquidity event with the more reasonable 2 to 3x to 5x return. And they're putting bigger dollars at work. So they're putting down 30 million, $100 million, $400 million. They're really moving the needle with high volume of dollars. So they only, if they get a 20% IRR, that's a lot of money. And they're again, how funds are incentivized, the 80-20, 20% carry. So they only have to make a little bit of money, percentage on the return to get paid a lot of money on their carry. So like that's kind of the strategy of growth capital for most cases.
On the same question, so when these deals are happening, they're potentially wiping out angels and early stage investors. So how do they react to something like that?
If this is a great company, everything's up and to the right, the company's running strong, founders won't accept terms like this.
Okay.
This is more for kind of the mid-tier companies that have built good companies, but they just maybe didn't manage capital right. They, were living off the free money for too long and they made some mistakes. And they need the additional capital to have another shot to grow the company. If you're like up and to the right, everything's going smooth, it would either be zero liquidation preference or traditional just 1x. liquidation preference, and that doesn't really impact the cap stack as much, or the pref stack. So ideally, you're an angel investor, seed investor, and everything. Again, this is like that one of a fund's portfolio of 30 companies. This is your one that has no problems. It's been going like this the entire time. That you're hopefully going to get your big return, and you don't have these kind of complexities in your pref stack. But you made 30 bets, maybe you're 10 other ones that are doing okay, or maybe they're like, whatever, they're not like that strong, but they're still in the portfolio. Maybe something happens. Those are the ones that usually are struggling. And they have to, that investor that has, some follow-on capital has to make the decision, like, for the other 6 bets I could make with follow-on capital, do I want to back this one company and get maybe some more aggressive terms and get an earlier exit? Or do I want to kind of still take some more the bigger moonshot opportunities and not have any kind of protections and things of that sort? So it becomes like a strategic investment decision at that point. So the pref stack stuff is more for those companies that, maybe missed milestones or spent too fast, those types of things. That's essentially their punishment. Or the market shifted and no one likes that sector anymore. Or, multiples are getting hit. So something, maybe a macro effect that's outside of their control. They've done nothing wrong. They built a great business. It's just investors don't care about that sector anymore. And so they have to basically financially engineer returns with like liquidation preferences and certain preferences.
Can Thunder help such founders?
Yeah. We help companies figure out what's more realistic. We have a client right now. We had to kind of restructure how they thought about their capital round. They didn't realize that the market had shifted. They kind of built this great company, millions and millions and millions in revenue, good business, really sound foundation. They just need a little bit more capital to get to profitability. And they were trying to raise on terms that people were trying to raise on in 2021. And, that's just, it's changed. It's a different world. And so we helped them kind of figure out what's realistic and, kind of help them manage their expectations. And shortly after doing that, they started getting capital in the door. They started getting meetings. Everything started working when they kind of reshifted their focus on who they were going to and what they were presenting in terms of terms. And they have a lot more momentum on that front. So we add a lot of value to founders just from that advisory perspective, in addition to capital introductions, but also just on that advisory element of just kind of figuring out what's the right path for them. And so it varies on, everyone. Sometimes up and to the right, everything's easy. It's just about capital introductions and, helping them, find the right people that could be the best partner. And then the other side is, structuring the company, structuring the deal, structuring, what's going to be a good yield for investors and identifying which investors actually care about those types of opportunities. So it's complex and bespoke to each, client, but that's.
Okay. Awesome. So, Jason, what we do is we have a decent big of an audience. And like every single time there's a guest coming over the podcast, so what we do is we send out this note, like, Jason coming tomorrow. He has like, amazing background. He's helping people and all that. So, and 80-90% of our, listeners and viewers, they're either first time founder or they're like aspiring entrepreneurs. So, and they're kind enough to, send in some other questions. So I want to ask you those questions so we can, help somebody else out. Okay. They're not in any particular order, so just like randomly. And I think some of them you have already mentioned, so I'm not gonna ask you the same ones again. So the first one is, how much should I raise in an initial funding round, and who should I approach?
Without any context, that's a tough one. The best way to look at how much capital you need, if you're like a pre-seed, seed stage company, how you need to build your financial model. And I know a lot of founders, financial models are pointless. It's just making up numbers. It's an important exercise, like to think about what might come your way and to have a conversation with prospective investors about your thought process. That's an important thing to do. But when you do that, if you're a pre-seed raising a pre-seed, the strategy now in this market is find a way to give yourself 24 months of runway. So 18 to 24 months is kind of the minimum runway you need to go and get before you have to go out for another round. And then what's that runway for? It's to hit the milestones that will either bring you to profitability and self-fund yourself moving forward, or be able to acquire the capital for the next round. So you need to look at what are the milestones. If you're raising a pre-seed, milestones for a seed right now is about at least $250,000 in revenue, some kind of validation, in terms of product and customers, maybe not real product market fit yet, but like some serious validation. $250,000 to about $1 million, $1.5 million in revenue. Like that's what seed deals are getting done right now. So if you're pre-seed, pre-revenue, you need to raise enough money to kind of hit those milestones. And ideally with this kind of velocity. And that's something else that we talk about is like, how do you engineer up and to the right? Because sometimes, companies are like, oh, we did it. And then like they can't sustain it and they, collapse. They're still like much higher than they were, but like anything, if you have anything that goes like this, when you're raising money, it's just that the whole conversation just becomes 10 times harder. So it's like, how can you engineer this growth of, basically it's going to take you 3 months to build your product. And then you're going to have, 3 months to like market it. And then if you go out and you start seeing this little growth, you need 3 more months from the point that you start talking to investors here to keep this going. It's going to take 3 months to close. So that's something I always tell founders is like, how can you raise enough money to get the product where it needs to be, get the marketing and sales to where it needs to be, to where you can have slow and steady growth. Not like slow, but like, sustainable up into the right growth for at least 3 months. You need to have 3 months of, up before you go out and raise. And then you go out and raise and you need to sustain that up for at least 3 to 6 more months while you raise. Because again, maybe you have 3 months, 4 months of it going up to the right, but then you have a dip. All the conversations you have with VCs, all the conversations you have with investors will slow down. And it's just a harsh truth. So when you're modeling out your strategy, you're modeling out your business, make sure you have the capital that will engineer the growth you need for at least 6 months consecutive growth to hit that next milestone.
How do I assemble a strong founding team that I can trust?
Be a strong, trustable person yourself. I think is something that sounds simple.
Very hard thing to do.
I just thought, I'm on like a couple of founder Slacks and groups and stuff like that. And I see one founder like, I'm doing all the work and my CTO is not keeping up with the pace. So there's all kinds of like horror stories of, people. It's like when you usually hear one side from the founder, from one founder, but you don't necessarily always hear the other side. Founder turmoil could be one issue. I can't necessarily tell you how to find the perfect founder. A lot of it's serendipitous or just, really getting yourself out there, meeting people and building relationships and seeing what happens. But one thing I try to mention is very important because I've made this mistake in my past. When you go to pitch investors, they look at your chemistry. If you ever have your co-founders in the meeting, like the chemistry between the founders is obvious as day in any meeting. Like if one founder starts trying to talk over the other, dead, just dead. No one VCs are like, okay, these two don't get along. It's going to be a struggle. There's going to be like power struggle. There's going to be something going on. We don't want anything to do with that. It could be a great business, but they in most cases, the business would have to be like this for a VC to, deal with that stuff. So founder chemistry in the meetings is like super crucial. And I made a mistake early on, kind of trying to be, taking over some of the talking points and like kind of strong arming the other, founder. And, we fortunately got some feedback saying, Jason, cool it. You're making a mistake here. Like we just blew that whole meeting. And I got it from a third party we trust. So it's like, okay, it wasn't just the other founder complaining. It was like, no, this is legit. I'm making a mistake. And then the founder and I worked on it. We went back and forth. We practiced what we're going to say, who handles what, how do we hand over, what topics and stuff like that to each other. And the chemistry immediately improved. And, we were able to go on and raise the money we needed to do. Because if we didn't fix that chemistry issue, VCs will just quietly not care about you anymore and ghost you. And, that might be one of many reasons, but that would be a reason and a red flag in particular that would write off.
What are the other red flags that you think VCs usually have in mind?
I'm actually working on a piece of content on that right now. Let me see if I can pull up my visual I'm working on. Oh, this is a good one. Little but obvious lies.
Okay.
So what this one is when someone's like, oh, we have 25,000 MRR. and they call it like MRR. It's like, no. You're not a SaaS business. You're like a transactional business. You don't have monthly reoccurring revenue. You have monthly revenue. That just pisses off founders. When you call something like, oh, we have $1 million ARR. It's like, well, no, you did some consulting projects for like $500,000, and then the other $500,000 is like the product sales, and that's not even, so it's just like, call it for what it actually is, and then make sure you're using the right terms, because as a founder, it could be just an honest mistake. They might
not know that,
not be trying to mislead, but it also makes you look like you don't know what you're doing. So whether you're misleading or you don't know what you're doing, both don't look good. So that's a really big one. Any kind of like heavy emphasis on like anything that's more about your ego as a founder, where you're like, I did this and I'm the one that, figured this out, and no one else can do what I do. It just kind of sends like, this guy's got a big head, or girl has a big head, that they're going to be difficult to work with, and they're going to butt heads with others. They're not giving credit to the team, any of that kind of stuff, and they get to see like leadership dynamic issues. Poorly designed materials is something that is kind of a subtle one that a lot of VCs don't really say anything about, but it happens within like the first 5 seconds of them reviewing a deck, which leads to almost no meeting happening. So a lot of founders hate doing decks, and I get it. It's a lot of time. You're constantly reiterating them. You're constantly changing them, but that's what it is running a business. You're constantly iterating and changing and evolving and, moving things around. And if you don't put your best foot forward in one of the most important materials you ship out to investors, and you don't invest in the design and layout and structure of it, VCs only spend about 5 to 15 seconds, maybe 30 seconds on deciding if they want to spend, 30 minutes with you or 15 minutes with you, whatever it is. And your deck has to stand out polished and get that across. So it's either you have a killer business that is ultra clear, crystal clear to understand that there's opportunity here, and it can be black and white slides. But if you don't have that super crystal clear, awesome, everything up into the right business, invest into the design, invest into the structure to really make sure you're articulating what makes you special and why you're the team to do it, and so on. And I feel a lot of founders just cut corners because they just want to get out there and go, and that's going to send the negative signal to VCs and potentially lead to no meetings. There's a million red flags. I've written a couple posts about them. We have a couple newsletters about them, and I'll probably continue to post about it. But this is something you can talk about for ages, that founders just don't realize that they're making, and just researching what VCs think are red flags and not doing those can help your chances substantially.
Yeah, okay, I agree to that. All right, Jason, thank you so much for all the candor, all the insights, I would say, into the venture world. I really appreciate the time. So we do have this one small ritual on the podcast. So what we do is we ask all our guests a question for our next guest without telling who the next guest is going to be. So I obviously got a question for you, and then I'm going to take a question for our next guest from you as well. So the question that the last guest left for you, and he runs, a couple $100 million fund. So he's a VC too. So just keep this in mind. What's one fundamental belief about venture capital that you disagree with?
So venture capital is all about taking risk. That's kind of the fundamental belief of it. And, it's all about, like, oh, we're going to pick the one winner and, the needle in the haystack. And I do fundamentally disagree with that in some regards from a concept, because that's what a lot of founders get frustrated over. It's like, oh, why aren't you betting on me at my lowest moment? You got to take risk. And it's like, well, they have a fiduciary responsibility to their LPs and to return capital to their LPs. So the best VCs don't look at, don't try to think of this as much as like super high risk, but like, how do they mitigate risk by investing in companies that have a lot, higher probability of sustainable growth and, hyper growth for exit outcomes. So I just think that's, founders come in there thinking that, they should be getting these early bets and so on, and have this like kind of expectation, where on the flip side, VCs, it's about returning capital to their LPs so that they can raise capital again. Because if you don't return capital to your LPs, they're not going to invest in you again. And so they have to make those types of bets and be able to present to their LPs why they made a bet on you, and and share all that information. So I think it's important for founders to really recognize the other side of the coin, and that will help them better position their opportunities and de-risk and express the different. I have another post on risk factors that go into a deal, and addressing those risks, one by one, will help make it easier for the VC to, write a check. So just something to kind of think
Okay,
about.
awesome. Thanks, Jason. Appreciate the time. Appreciate the candor. Thank you for just, giving us real insight into the venture world. And I hope it's going to help a lot of people. So I appreciate the time.
No, appreciate it. And thanks for having me on the podcast.